about the situation regarding Ferrari prior to this IPO. And why are we doing IPO in the first place? Yes. Okay, so I heard the keyword spin-off, right? Because right now, our company is actually part of FCA, a Fiat Chrysler Group. That's right, Fiat Chrysler automobile, sorry. Which we could refer as FCA. So Ferrari is actually a subsidiary of FCA and want to spin off the company. And maybe you say you want to spin off because, okay, unlock value of the company. Fantastic. So, as David mentioned, it's actually, our case is not really about an IPO per se. Okay? It's more of a spin-off activity of a privately owned subsidiary of FCA. Ferrari is almost wholly owned, right? You remember the share ownership proportion between FCA and the Ferrari family? Sorry? No? Anyone remember the numbers? 90 and 10, thank you. So the Ferrari family owns 10% and FCA owns 90%. Right, it's a company under the FCA group. And FCA sells many cars. Zoom out a little bit, zoom in a little bit so we can see more. Okay, so FCA sells other cars, so Fiat and so on, and Ferrari is just one of the companies they have in the portfolio, and they want to list the stock so that they can basically spin off, right? Spin off the company into the market. So, how would you characterize Ferrari company? Would you call it a car company? Some yes, some no. We're selling cars, right? We're selling cars. But we're just selling cars. Our revenue structure suggests otherwise. So what are our sources of revenue as a company? Sponsorship and merchandising, licensing, right? So the logo that we, thank you, one of you guys had the logo here, so I'm going to show it to you. I guess probably see a lot of our merchandises around that carry this logo, right? Ferrari around, and they are earning merchandising revenue from that too. So can you recall any other brands you've seen in your life that started itself as something else and then have their names on other products unrelated to core business?
Almost all football companies.
Almost all companies. All football companies, okay. Sports companies. Merchandising revenue is actually a big part of our sport franchises. Anything else you've seen in life? Sorry? Porsche, that's exactly the same thing, right? Porsche design, like wallets, pens, and so on, right? Even something closer to you than that, right? You get coffee every day, perhaps at Starbucks. Starbucks derives a good deal of revenue not from selling coffee, but selling the merchandises like the cups and so on that you buy. So a lot of brands, okay, try to not to stick to themselves as sellers of products, okay, but trying to convey themselves as a purveyor of lifestyle instead. So, what you associate with the Ferrari brand, you can also extend that brand image onto other products and become more of a lifestyle company overall. You may have seen like Sing, for example, right? They had Sing fashion wear as well, doing something quite similar to what the other brands are doing. So, lifestyle products from licensing cross-merchandising deals. Okay, so let's go back to this point, okay, about unlocking the value of the company. Okay, when you hear this word, okay, what do you think exactly it means? How do we unlock the value of the company? Why is it wrong, or why is it not optimal for us to remain under the group of FCA? What's the advantage of Ferrari going out by itself?
It will be judged solely on its own merits, financial merits,
Okay.
which is quite good. If it was part of FCA, then it will be not a small portion, because it provide a large revenue, but then it will be settled down with the valuation of all the other product lines, other brands, and whatnot.
Right. So your argument is that if we list as a separate company, then we view as a company entitled to its own. If we combine with other groups, maybe the other stenches of other parts of the group maybe rub off on us if we don't get the full valuation. Right? So maybe going to be valued as a luxury company. Okay? So this kind of argument has at the back of our mind an assumption that investors don't value company as sums of their parts. Because if we assume investors are valuing companies using full information and also full appreciation, then the sum of the FCA group would just be the Ferrari group plus the rest of the group, and then the value combined as a conglomerate would be exactly the same as the two companies broken apart. So the argument here relies on the belief that when you combine the two together, somehow the valuation of the less glamorous part brings down the valuation of the more glamorous part. Okay, certainly there's some research areas on this too that talks about this. Any other reasons why spinning off is a good idea? Maybe let's not focus on just the word spin off, but an IPO. What does an IPO do for Ferrari, or Ferrari, I guess, management, instead of being under FCA? What are the pros of being a public company as opposed to a privately owned company? Anyone? Yes.
You can achieve better cost of capital.
Cheaper cost of capital compared to private company, right? So you're able to tap the public market as opposed to relying on a smaller market where your bargaining power may not be as high, right? So good. Maybe opportunities of fundraising, more opportunities tend to translate into lower cost of financing, so therefore lower cost of capital. Okay. Any other reasons why you might want to list a company instead of having it remain private?
To increase.
Yes.
Maybe the diversification of the owners.
Okay.
They all
So they can exit, right? I guess the key word here was that if you are a privately owned company, you are fully concentrated in that company. You want to exit, but you might not be able to exit very easily and come back in again when you want. So when you have your shares listed in the market, you have liquid stocks, or at least more liquid stocks. You can sell when you want, and also you can buy back when you want as well. So that's the benefit of having publicly listed and traded shares. It allows the owners to diversify the risk away without the risk of losing control. Right? Okay, good. What about if you work for a company? Would you rather work for a private company or a public company? Depends. Yes.
Maybe does it have to do with the remuneration of shares?
Right. If you work for a private company, the only way for you to benefit from a private company is for the owners of the private company to say you are allowed to participate in the success of the company. So your future remains in their hands. But if you are a public company, then you don't need for the owners to reward you. Because if you own the shares and the company does well, you benefit from the success of the company directly. So one of the benefits of listing in the stock market that a lot of people experience when I say list that stocks is that employee turnover goes down, right? Because when you were in a private company, you kind of have to hope, okay, that the owners appreciate you, and you may get fed up at one point. But if you're a public company, all you have to do is to buy the stocks of the company, and then you get to ride the way up as well with the company, right? So it's easier to motivate employees, it's easier to align the incentives. We've learned about the incentive alignment, I guess in some of the finance theory class you've learned that, if you give employees stock options or even just stocks, it aligns their incentives. Well, you don't need to give them stocks because they can buy stocks too. Right? Your private company, sometimes you give stocks to the employees, but that's not very often. Right? Startup companies, for example, sometimes have what they call an option pool, so that they give stock options to key employees so that they get to benefit from the startup success. But if you are private, if you're a public company listed in a stock exchange, you don't need to do that because your employees can do that by themselves too. So that's another benefit of listing in the stock market. Okay, what about the cost of listing? Are there any downsides of listing in the stock market? Do we have anyone here who works in investor relations department? Typically we get IR people in this class too. Guess not. So let me ask you, what do you think an investor relations department does for companies? You're an IR person. Yes.
Maybe we have to share any information to the public which may not be, which the competitor might learn about the strategy of the company.
Right. Okay, your investor relations department, you're meant to answer questions that people field at you. If you're a private company, when people ask you questions, you can just say, sorry, I decline to comment. If you're a public company, when people ask you a question, you say, sorry, I don't want to say anything. Sometimes you get away with it, okay? If people are willing to have faith in you, but not always. So you're required to reveal information to the public, and that sometimes may involve revealing private information that you don't want your competitors to know. And think about when you do benchmarking analysis. Hey, what's the best way to benchmark performance on either company X? Well, the best way is to dig up investor presentation of company Y, because then you get to see almost the deepest level of information that they can provide to you. So when you're in the stock market, you are required to disclose information to the market so that the general public can at least get a sense of what you do. Now, you don't need to reveal a lot of information, right? Because even for companies like Google and Apple and so on, they have a lot of things they hide away from public eyes. But as I said earlier, okay, if you can get away without telling them, no problem. But when the things aren't going very well with you at a company, then they're going to start asking very difficult questions. So you might want to listen into some of the analyst calls. And sometimes companies hold a call session with the investors to take questions and then address the questions that they have raising that concern. So disclosure, so that's both dimension disclosure, right? One, you have to disclose information every now and then. So there's a cost of actually making those disclosures. For example, sending annual reports. If you own stocks, okay, every year you get a brown envelope from TSI containing a CD and a paper book, because the Stock Exchange of Thailand has a law that says you must send these CDs to investors. So if you were wondering who were buying those Pringle CDs that went expired, well, we have lots of rules like that require CDs to be submitted. Your SP, for example, needs to be submitted on CD. I think the university rule still says that. So better luck stocking those stuff because they've just discontinued production, right? So that's the disclosure, the direct cost of disclosure. Indirect cost of disclosure, you tell information, maybe TMI, right? Too much information disclosed to other people can sometimes be a weakness for you too. So you have to balance between being in or being out. And sometimes there are companies who used to be in, they said, you know what, being in the stock market isn't worth it for me. I'm going to delist and become a private company instead. at one time, the paper company, AAA, used to be in the stock market. And then they said, forget it, it's too much being in the stock market, so I'm going to buy back shares in the existing investors and delist on the stock market instead. So sometimes that happens too. Okay, so we see the cost, we see benefits. This time is it's quite clear because FCA wants to list Ferrari because they think Ferrari is going to be valued a lot more than right now under the umbrella. So that's the way the case is written to appear, right? They call the Ferrari as a crown jewel of the FCA group. So they want to make sure that they get the most value out of this, so they want to list this company separately. Because there's some evidence that you can be a car company, but people can value as a different kind of company. Look at the list of comps. That's one company that really stands out, okay, from everyone else on the list. And that company doesn't really have any earnings, yet the valuation is skyrocket high, and that's Tesla. Because people didn't really think of Tesla as an automotive company. Tesla is being viewed more like a tech company. So the idea here is that if Ferrari is being viewed as an automotive company right now, why not list in a stock exchange? Maybe we can be viewed as a luxury company instead. Like Hermes, for example, Louis Vuitton, that they said as, they put as cost. So that's the idea, right? Sometimes investors may have some certain affinity, some certain attachments to that brand value. So therefore we're gonna list and take advantage of that perception instead. Okay, cool. So in terms of valuation, what do you guys get in terms of value? What kind of numbers do you guys get? Euros or dollars? $53. Okay. 52, 53. Anyone else different numbers? 52. Okay, you guys are so harsh in this company. So when you told me those numbers, how did you value the company? How many methods do you use to value the company? DCF? DCF, okay. Using the Exhibit 8, some multiples, okay, EV, EBITDA multiple. Okay, so we use EV, EBITDA multiple. How do you use EV, EBITDA multiple? Okay. So you can use luxury if you want, okay? They're also automotive, but I guess you guys didn't want to use those because they're a little lower compared to the luxury multiples, right? What kind of numbers do you use for this? 12-ish, 12.7, okay. Somewhere along that line. For cars, a lot lower, right? What a multiple for cars? Yeah, depending on whether you use mean or median, right? If you use mean, then it gets pulled up a lot by Tesla. So if you use median, maybe something more like 6-ish. Or do you want to benchmark against some particular brands instead? Because here you're using median, okay, or I guess all companies in the sector. Do you try to benchmark it against maybe selected companies in the sector instead of using all of them? And those are alternative ways you could do too. If you look at the list of the comps that's been given to us, okay, we can do a quick EV EBITDA ratio here. And you see some of the companies have very high EBITDA, even for Ford, General Motors, and Hyundai, and so on, and luxury brands, some of them have really high EBITDA like Hermes and so on. So do you choose all multiples, choose all companies, or do you match? Yes. Very good question. What do you think? Okay, so if you deduct cash, okay, if you deduct cash, do you deduct all the cash? So this is an open debate, right? You raise a very important point, right? If you don't want to look at the EV of the company, then theoretically, okay, it should include everything the company needs to operate already. And cash is part of that. But the question is, 100% of the cash, would you want to exclude 100% of the cash, or would you want to include some cash as operating cash as well? Alright, so here I deliberately did the EBITDA multiple by not deducting the cash. So, for some analysts, for some groups of financiers, they will say, no, this is a little too much because you are including the value of the cash on hand too, because cash on hand counts one-to-one as your equity value. If you take the cash out, you could have paid that cash out as dividend, so equity could have been reduced by paying out the dividend to shareholders. So you could do cash adjustment, okay? You could remove all the cash and have a lower multiple. That's fine. Okay, if you do this without excluding the cash, it tends to overestimate the multiple value, because if you look at a company, some companies up here, you may argue that they probably have a little too much cash on hand compared to what they need. For example, Fiat Chrysler, Ford Motor, and so on. You compare them to how much sales they have. You probably think they can have a little too much. So one way for you to do that, you could do this, is to think about what assumption should I make about the cash requirement for this business. So one approach is to look at maybe the median value of cash holding, assuming that not every company holds excess cash. Another approach might be to look at just Ferrari right now. How much cash does Ferrari hold compared to the EV of Ferrari? Or even to sales of Ferrari. To support this level of sales, how much cash do we have on balance sheet? And you can use that as an estimate that maybe other companies need to hold similar amount. Right? So the cash to sales ratio of Ferrari is about 13%. So one way is to calculate what is 13% of revenue for each of these companies, deduct that from cash, and treat the rest as excess cash. But very good. Okay, so you are we're supposed to think about the excess cash issue as well, because otherwise we're including value that isn't really coming from the operating value of the company. Okay, very good. That's the first point. Second point, when you pick comparables, are there any issues that you might want to have as checklist before you pick the right comps for the company? That's new.
In the note,
Yes.
note that is equity value is 2015,
Mm-hmm.
and another one is 2014.
Very good. So when you calculate this multiple, when you apply this multiple to EBITDA of Ferrari, which year do you use?
Use EBITDA that one 25 baht per base.
Okay, but EBITDA in which year of Ferrari?
No, I mean in the table that
Mhm.
EBITDA is 2014.
Oh, so you project the growth rate onward. Okay, that's possible too. Okay, you can do that and then get the multiple. Alternatively, okay, you could do the EV/EBITDA ratio and treat it as a trailing EV/EBITDA ratio. Okay, forward value of equity, but then backward value of EBITDA, and then apply. So the key thing here is to have the consistency. If the numbers being provided are EV of 2015, I guess, and then EBITDA 2014, the multiple needs to have the same type of input. So you want to use the 2014 EBITDA input for Ferrari instead. Alternatively, you can project the EBITDA out to be 2015 and calculate the contemporaneous EV/EBITDA instead. Another type of EV/EBITDA multiple you may see is the forward EBITDA. Right now, the value at 2015 is this, but this is the estimated EBITDA for 2016. That's called the forward EV/EBITDA multiple. The most important thing is to match. Okay, how are you calculating these multiples? You want to use the same convention to calculate the multiples before you apply the multiple back to your whatever metric that you want to be using, EBITDA or even earnings ratio. Very good, very good. You noticed that. Okay, so the case deliberately did that because they want to show you that well, you can pull anything that you want, you can do any ratios that you want, but the most important thing is that you're applying it to the right set of numbers. Second point I want to talk about is selection. Okay, do you think all of these companies are good comparables for our company? Yes. Zai.
Most of the auto manufacturers are not, I would say.
Okay.
Better if they had companies like Lamborghini or Aston Martin or
Okay.
Porsche, which are more in line with.
So you're pointing toward the business model, right? The business model, we want to have luxury cars in the same category as us, as cost. That's the first thing we should always consider. Okay? Any other thing you might want to consider? Business model matters. But if you have two companies, they're both luxury companies, but one is growing very fast and one is at the stable, steady state already, what do you think would be their multiples? Are they going to have similar multiples? No, right? The case gives you information on the projected growth rate. Because one of the things that affect the multiples is that multiples actually incorporates the growth opportunities in there. Sometimes companies have very high multiples, not just because they're profitable, but because they expect to be profitable in the future. So right now, okay, we're still growing to catch up to that level. So matching firms by that stage in the growth cycle also matters a lot.
But doesn't it like also depends on the industry? For example, right now in the auto manufacturing industry, there's only Teslas like that.
Right.
Right. And Tesla has come about. I don't remember any other company like that. I mean, grew that fast because
Right.
niche products do.
For this reason, Tesla multiple will not be comparable to anyone at all because of that just insane growth opportunities being built into the valuation today. Right? So that's the point that I want to bring across. If you want to treat every other companies as similar, that's fine. But that is a reason why the growth rate needs to be taken into account when you pick the right comps. So why do you want to have companies with similar business models? Luxury companies versus not so luxury companies. What do you think is the main reason why we want to match those? Okay, profitability, right? Some companies are more profitable than others. If you have two companies, though, equally profitable, but the source of revenue are a little different. One company is very profitable, but is very exposed to changes in economic condition. The other company is very profitable, and no matter what you do, people buy your products anyway. Which one do you think is going to have higher valuation? The latter, right? The one that has a lot less risk. Because if people don't really, if your company doesn't have a lot of risk, people are going to be more open to investing in your stock. They have a higher valuation. So the third component that you might want to match is the systematic risk that the company is exposed to. So using multiples is a very convenient way as a shortcut, okay, but it hides away very important assumptions that without being able to explain or match those, the multiples you use are not very meaningful at all. So when you do your comp selection, bear those in mind. Okay. There's fourth point, but a minimal relevance. Okay. Two companies identical, one company has a lot of debt, one company has not so much debt. Which one is going to have higher enterprise value? Identical business models, identical operating business and so on, but one has a lot of debt, the other one has a little debt or no debt. Right? Debt has tax benefit. So tax shield is another component that goes into the value of your enterprise value. So if you have companies with different leverage, then the multiples are going to be mechanically different because a company that has zero debt, same EBITDA, but it's going to have lower EV. So I think those are the main important academic points I want to get across. Okay. On selection, okay, you need to have comparable business model. Okay, so this comes in two forms. profitability, which you can see through ROIC, right? And then risk, which is reflected in the cost of capital or WACC. You want them to have similar comparable stage in growth opportunities. Business life cycle. And you want them to have similar leverage. These are the three important elements that if you want to use multiples as a way to value, then your comp selection strategy needs to be aware of these 3 points. Okay, DCF, I guess all the ingredients are there for you to do DCF. In fact, you could just do the NOPAT minus change in invested capital, and you have a free cash flow for the company to do. So I think that's simple enough. But the more important question is, what kind of growth rate do you project for the outside planning period? What are the popular numbers? 2, 3, 2.5, all reasonable, right, around that point, because you want to be using the rates that you are pretty sure you can sustain indefinitely. And so the long-term interest rate given is about 1.7%, so you know that inflation is pretty low in this environment. So long-term growth rate for most companies, for most developed economies, tend to be about 2%. So the safe numbers you use typically is about 2 to 3%. So you typically would do a sensitivity analysis to see if I change these assumptions, what happens to my valuation and so on. What about WACC of 5%? You guys, are you guys okay with that WACC of 5%? You don't have more information, sure, but what does it take for a company to have WACC as low as 5%? What is a key assumption behind, I guess, the business that we need to be comfortable with? We have WACC as low as 5%. Oh, sorry? Right. So the main assumption here is that our business model has very low systematic risk, right? Whatever happens to the economy, we still sell anyway. So to the extent that we're happy with this assumption, then 5% you can use as the input for this model. And the case doesn't have any information to go beyond that we see the long-term interest rate is about 1.7%. So this tells us that beta is going to be less than 1 for sure, because risk premium tends to be about 6% or so on. So your beta here is probably about 0.5 or 0.6 for this company. And there's a slight issue about using debt, but as you've seen in some previous exercises, when you do the levering up and down, typically when you have more debt, your WACC gets affected by a minimal amount. So the main determinant of cost of capital is not really how you use your financing, but it's more about how your how your business risk is, and that's the main driver. So here we have a assumption that we have a low risk business, and I guess based on the way Ferrari brand is perceived, that's probably reasonable. Given the way that they always undersell according to their demand, so it doesn't really matter whether the economy is good or bad. You always have like a buffer room to fulfill that demand. Okay, so we use those methods and get the valuation, and then get the final valuation, and then you have to think about the pricing. So I guess not what price you offer, but relative to the value that you give, at what price do you think you should list? Should you list at a price above value, same as a value, or less than the value? What are your recommendations? Suppose we get value of 55, can we maybe ride on the fact that it's 10 times oversubscribed? So people really want it, maybe the value is 50, but I'm going to sell to you at 60. That's one possibility. I can sell at the same price as my valuation, fine, no problem. just get the fair value, leave no money on the table. Or I can sell at a price below the valuation. So what do you guys recommend? Below the value? Above? Above? At the value. Okay, all three possibilities are being covered. That's big. So I think this is the point where I can speak a lot more about the theoretical research behind this, right? Why, sometimes you may want to charge a different price compared to value. We talk a lot about in finance that when markets in equilibrium, price equals to value. So the natural tendency for us to price is that why don't we price exactly the same as value so that we don't leave any money on the table? Okay, exploiting the hype is also one thing, right? But there's no guarantee that that's going to happen. So maybe a more conservative approach would be to just price exactly equal to value so we make sure we don't leave any money on the table at all. Turns out there are a few theoretical reasons why you don't want to price at the same as value. Empirically, okay, if you look at most IPOs around the world, we tend to price below the value. You see financial analysts do the report just like what you do, maybe DCF report, maybe multiples report, get some valuation and then decide, okay, the value of this firm is maybe $6 per share. We're going to price it at $5 or even $4.50 sometimes. The question is this leaving money on the table? Maybe, right? But okay, how much money are we actually losing? Suppose we underprice by 10%. Okay, do we lose 10% of the whole thing? Typically, we don't list all the stocks, right? We tend to list, just above maybe, or that's a minimum requirement when you list a stock. How much you have to give up? You have to bring outside people, like free float requirement. So you tend to see, and that's a minimum bound in most countries, how much you have to sell to outsiders. And there's a trend of research that talks about this as well. I think it's Leland and Pyle. I'm not sure whether you guys covered this paper or not. About asymmetric information, right? If you want to sell your company in IPO, and there's asymmetric information about the firm quality between you and the outsiders, you want to keep some of the stocks, maybe a lot of the stocks, on hand to convince outsiders that, look, I'm not selling you lemons because even I am still holding on to a lot of these stocks. So if the company is bad, I'm also going to suffer the same fate as you. So people call this skin in the game. Skin, right? Skin in the game to address asymmetric info. I think this is Leland and Pyle. I'm not sure which year it is. Maybe 1996. I don't know. But the papers are silent about pricing. Okay? They tell you about in asymmetric information, you should retain key ownership. That's why when you go to stock markets around the world, they have a minimum, listing that you have to do, but they also have a cap on how much you can sell. You don't want to be selling too much because it sends a wrong signal to investors that maybe you're dumping these shares. Not a very good signal. They also have lockup periods like I talked about last time. But there's also another strand of research that talks about pricing, especially in the existence of asymmetric information. Right? If you're able to subscribe to the IPO, you don't really have a lot of information about the company. But if there are other people who have more information about the company, then you might be concerned that as retail investors, why the hell do I get access to those IPOs in the first place? Okay, this is called winner's curse. When you get allocated IPO shares, you ask yourself, what am I reading? You see a lot of people talk about if you get IPO shares, you're guaranteed to make money. That's not empirically true. Sometimes the first day the IPO trades, you lose a lot of money as well. And the winner's curse argument goes like this, right? If you get allocated the shares, remember that insiders and outsiders. Insiders sometimes are institutional shareholders or people who have favors with the companies or just rich investors. So they always get the first pick. But if you get to buy this IPO, that means the other guys didn't want this. So why the hell am I getting this IPO? Maybe it's not a very good IPO. And if we know this, okay, then we don't want to be buying those IPO at all. So underwriters, in a way to try to attempt to entice us to come in, they tend to underprice all IPOs anyway, okay, just in case some allocations are given to individual investors like us. On average, we don't lose money. We might lose money on individual deals, but on average, we still maybe make a little money or maybe break even, so that in the long run, they can entice people to come in as well. So I'm going to pull up some of the slides that I prepared on this. Actually, let me send this to you so you can look at this as well. Okay, so there are 4 files that I sent you. Okay, 2 of them are lecture notes and 2 of them are spreadsheets, which hopefully you'll get time to finish by the end of the day. If not, okay, you'll prepare you for the next case you have to do. All right, so here's a list of, I guess, reasons why people IPO, and whether it's good or bad. We talk about a few of this, right? More access to capital markets, so you can lower cost of capital when you have to access the capital. About employee compensation incentive. For the individual owners, you have more liquid wealth. You can exit when you can. Because sometimes companies do this to exit the investment. You heard a lot about venture capital investments. When you invest in startups, typically the final goalpost that they want to be moving toward is to IPO the company so that they can get their initial investments back. But there's also anecdotal evidence that when you're a listed company versus unlisted company, people tend to treat you more favorably because they can look you up more easily. Okay, you're more transparent. So your relationship with your customers and your suppliers tend to improve as well as a result of being a listed company. And also when you're listed, okay, one of the most important issues, which is going to relate to the next point, next topic we talk about, is that if you're listed in the stock market, you can be taken over. If you can be taken over, it provides you with a certain measure of discipline that you can't screw up the company. Because if you screw up the company, somebody else is willing to come and then challenge you for ownership. So we're going to talk about merger and acquisition later today. And another name for merger and acquisition is market for corporate control. Because what it is essentially is that you have a firm in the stock exchange which you think isn't being managed very well. So I'm going to contest the current owners by buying up the shares and then wrestle away control from the current owner so that under my management, under my leadership, the firm can be improved. The cons, of course, okay, it consumes the company's resources, not just money, time as well. If you're a listed company, you have to go and meet investors. If you're CEO of big listed companies, most of the time you spend tend to be meeting with key investors. Right? If you own a lot of shares in a company, you have the right to demand to talk to company management. And to the extent that that time can be spent managing the business instead, it's an important resource that firm management must allocate to appease investors. And in addition, when you have firms listed in the stock exchange, sometimes investors might be more interested in short-run results. Are you getting quarterly improvements or not? So that may influence a firm decisions from long-term strategy toward more short-term, maybe less value strategy for the company. Okay, there have been cases where companies can think long-term. For example, Amazon, okay, one of the more prominent examples of companies that can do whatever they want in the short run, but they all invest for the sake of long-term. It took them almost a decade to really realize all that outcome of the strategies, but in the short run, they were under some pressure by investors as well. Okay. So here's some reasons why IPOs tend to be underpriced, and that's the reason we talked about earlier, winner's curse. And there have been some papers on this. So if you're interested, the main motivation by adding this kind of materials to our class is that in case you're interested in doing research based on this, you have a starting point, okay, of where to read and then follow up from that. So this is the theoretical paper, Why New Issues Underpriced by Kevin Rock. A long time ago, 30 years ago, we proposed a theoretical model that talks exactly about this point where we have informed investors and uninformed investors. And if we look at the returns of uninformed investors, we don't want them to be losing over time. So you must, underprice intentionally on average, so that when everyone participates, at least everyone gets to make a profit. So that next time when you do an IPO for a next company, people still subscribe to that issues. And that being some empirical evidence that in Singapore and also in Finland that seems to indicate this as well. Now, to do this kind of research, you need to know the allocations of the insiders versus outsiders. So in Singapore and in Finland, they were able to get those more detailed data. So they tested out the hypothesis that yes, indeed, it's the retail investors who tend to get the worst allocations. There's also another reason people put forward, is that there's a monopsony argument. Okay, monopsony is the opposite of monopoly. Okay, monopoly means single or concentrated sellers. Monopsony means single or concentrated buyers. So we have a small number of underwriters who are helping you in industry. So they have a concentration of power. So they purposely misprice their shares in this case. So that's a model of Barron's. This is a theoretical model, okay, from the monopsony in the investment banking industry, and then these are the follow-up analysis evidence that yes, it depends on the bargaining power between you and the underwriter. Sometimes the underwriter wants to have underpricing because in the end they can benefit from the underpricing because they get to profit the difference in the end. Now, when you do an IPO, if you are an investment bank, you're actually legally required to help, okay, to help the investors as well that buy in the end. So what they don't sometimes investment banks tend to be afraid that if I underwrite those shares and it turns out those shares performance aren't very good, I might be sued by the customers who buy shares from me. Okay, as underwriter. So to the extent that you might be afraid, okay, about litigations, okay, misrepresenting to buyers, firms just underwrite the initial price so that they get some returns in the end, so they don't come back and sue. And again, okay, here's some of the theoretical and the empirical papers. Now, this one of the points that people put forward more in the literature is reputation. Right? If you want to raise equity, IPO isn't the first time you're going to raise equity. Okay, you may come back to the market and raise equity again in subsequent futures. So reputation effect here says that if I intentionally underprice my shares at the beginning, okay, investors become very happy if they were able to buy this. So next time I issue my shares again, I'm gonna have an easier time selling my shares. So leaving a good taste in investors' mouth. So there are a lot of empirical evidence both in favor and against this. So here's a list of papers you can go and have a look at. There's also another strand of research that says, by the way, the underpricing and so on is mechanical, right? Remember, if we talk about underpricing, let me ask you this. If I want to talk about underpricing, as an empirical study, how do I know whether my issue is underpriced or not? What will be the statistics? What will be the numbers I look for to as evidence that there is underpricing? Initial return, right? The two types of returns people look at typically. Okay, the offer to open return and offer to close return. So open means the market open. I offer the stock at 4.5, the market opens, it created 6. That's the offer to open. The other one is offer to close. I offer the stock at 4.5, the market, the end of the first day, close at 6. So, intraday sometimes the stocks can go up and down too. There was one research at the Stock Exchange of Thailand research contest early this year and looked at the micro data of IPO. So he looked at the 5-minute interval in the first day, and it turns out, okay, most of the IPO stocks, okay, the stocks go up, okay, a lot at the beginning on average, about 18%. And then within the day, it goes up until about noon, and then it tends to go down. And by the end of the day, most of the returns are gone. Okay, so if you are buying these, then better make sure that you don't leave your position out until the afternoon. Keep your eye on the market, because in the afternoon, things don't tend to go very well. All right. So you would look at the 1-day return and then use that as evidence of underpricing. So if you have first day return being positive, okay, that's evidence of underpricing. If you have first day return being negative, okay, that's evidence of overpricing. So typically the analysis would use the average of many IPOs and say, on average, do we see underpricing or overpricing? And empirical evidence suggests that we see a lot of underpricing. So the first day return tends to be, on average, positive. But imagine this, okay, some numbers can be positive, some numbers can be negative. What we're looking at is the average, right? And the evidence says, on average, the number tends to be positive. What if I told you that numbers don't tend to be very negative at all? In fact, there's a lot more zeros than statistically they're supposed to be, right? If you have, say, 100 IPOs, and then you look at the frequencies of the first day return, whether it's positive by 1%, by 10%, and so on, and negative by 1%, 10%, and so on, you should see some kind of distribution around this. Okay? So one researcher found that the numbers, the distribution you get isn't a smooth distribution. Okay? There's a spike at 0%. So the stock that ends the day exactly the same price as the offer price, a lot more frequently than it should be observed. What would be your best guess as to what's going on here? How is it that it ends the day at exactly the same price as it opened at, a lot more frequently than you would observe randomly?
After market, like the firm, the underwriter try to control, not.
Right? If you're an underwriter, sometimes you have an agreement with your customer that, hey, I'm gonna save your face so that the first day we don't get a negative result. So I'll try to help you so that whenever it goes down to negative territory, I'll buy it back up so that it's at the same offer price again. Okay, so this is another strand of research that says what you look at as the average return is actually a censored distribution, because the numbers that are supposed to be negative, they end up being supported by underwriters. So when you take the average of censored distribution, the average number is positive. So the underpricing that you see on average might be just an artifact of the fact that we replace negative numbers with zeros. So we take the average of the whole thing, we tend to have our mean tends to be mechanically more positive. So here's a paper to talk about this. I'm not sure whether anyone has done this in Thailand yet, so you might want to have a look at this too. I had a look at some distributions too, but in Thailand, 0% isn't very common. Okay, so you might have to look at the evidence more on an intraday basis. Okay, so it might not end at 0%, but suppose you have an intraday graph. you track the price, okay, the return, maybe offer 2x return. So think about that as based on the offer price, okay, what is the return now? What is the price at now compared to offer price? Typically, you would see something like this in Thailand. On average. Not all stocks are like this. On average, it looks like this. But if you look at the individual stocks, maybe if some stocks look more like this, maybe it doesn't have to go to zero. You may induce that this stock probably is being price supported by an underwriter. Okay, the price support may not be exactly the same as the offer level, but we see suspicious that somehow it looks flat for a long time. This could be evidence of price support. So this is an interesting venue to look at as well by using the high frequency data that we have from the Stock Exchange of Thailand. Okay, and last one is bandwagon effect. So this is a bit about behavioral explanation, right? If you see a lot of IPOs doing very well recently, then you might want to get in on the next IPO too. And then the first day return might reflect the proportion of investors who wanted to buy the stocks but didn't really get to buy the stocks, so they had to buy in open market instead. So more like a herding effect, right? You see other people being successful in the market in IPOs. You weren't able to get in, but at least I want to get in the secondary market instead. So that drives up the first day return. Okay, so in conclusion, there are a lot of theories out there as to why we may underprice. So this says maybe it's not underpricing. It's just that it's being fairly priced, but somehow people really want to buy the IPO stocks in the secondary market. So the price goes up, perhaps even above fundamental level. So this kind of points out to a little difficulty in conducting empirical research, right? When we say IPO underpricing, we're making a very strong assumption that the price we see in the market at day end is the correct value of the stock. If that's the case, okay, first day return then reflects the extent of underpricing. The value is 6, you price at 4.5, so we interpret the gap of 1.5 as the actual underpricing. But what if the value is 4.5 and you price at 4.5, but somehow people just really want to buy the stock based on other halo effects instead? So you end up seeing a price of 6 at the end of the day, but that price of 6 is an overvaluation. That's the difficulty when we're doing empirical research, because our benchmark often is unverifiable. So this gives you a lot of research ideas, research opportunities, right, to provide alternative explanations to the phenomenon that we see. But at least on average, empirically, the first day return in Thailand tends to be positive. Okay, just to give you the background if you want to do research in this area. Now, as David pointed out, this case wasn't really about IPO alone. Okay, it's more about a spin-off. So in a broader class of research on this, it's about equity divestitures. When you have a company, you want to sell off a company. How many possible ways are there for you to sell companies? Turns out there are 3 commonly used words for companies to sell off the companies. First one is called a spin-off. A spin-off basically says I have a subsidiary. So I am going to change a subsidiary into a listed subsidiary by just giving the shares in my subsidiary directly to my existing shareholders. So graphically, it will look something like this. Okay, you're a shareholder and you own FCA. And then Ferrari is part of FCA. A spin-off would just be, I'm going to give you the shares in Ferrari. So in the end, you're going to own FCA. and Ferrari will now be an independent company. Just a simple rearrangement like this. A carve-out is what this case is doing. You list your subsidiary in the stock market, just a certain amount of it, so that it's now a listed company. And then as it becomes listed, I'm going to offload the rest of my shares onto the market. So either I can offload this directly, okay, I can do, or I can follow up with what's called split off. And split off is essentially, I'm going to force you to choose, right? You are now shareholders of Ferrari, of FCA. FCA is also shareholder of Ferrari. Right now, I'm going to ask you to choose, would you want to continue being shareholders of FCA? Or would you want to exchange a share in FCA for a share in Ferrari? And that's what a split off is. Okay, so I understand it sounds very confusing, but in the end, we want to get to this picture. FCA and Ferrari are two separate companies. Yeah, but the routes we take, the way we walk, is going to be a little different. And you may ask, why the hell do we want to use different routes? It turns out, okay, how you structure your deal matters for your tax burden. Okay, how you structure your deal also matters for the intermediate step. In case I want to change my mind afterward, can I redo this? Can I undo this? So, companies have multiple ways that they can do in order to split off their company, in order to divest their company like this. And there are good reasons, okay, why people want to do this. So let me show you some of the research. Okay, we talk about valuing company as a pure play. So there is some evidence in the first paper that talk about if your company you're listed as a group versus spinning off and listed as a pure play company, investors appreciate you more fully for what you are, and your valuation goes up. So that's the first paper over the divestitures and so on by these two guys. Another argument why you might want to separate your companies. Remember when we talked about the Chestnut Food case? Chestnut Food has two divisions. Okay, two divisions have different profitability and also different risk. But can you imagine the difficulty in going from a corporation where we usually rely on a single hurdle rate into a corporation where we want to use multiple hurdle rates instead? And sometimes there can be political, internal politics that prevent this from happening. So one solution the company can use is to, well, I'm just going to create a new company instead. I'm just going to spin maybe instruments out as a new company so that it can be benchmarked as it is. So when we allocate our resources, we can be more efficient. Okay, so there's another paper, okay, that looked at the division level when the company spin off the separate divisions as a new company. And what they found was that investment that the companies make are more sensitive to investment opportunities. You guys get to do the Vasari Harper Peterson paper, relationship between investment and the profitability in corporate finance. So that's a very classical paper, very long time ago. Vasari Harper Peterson, I think 1986, that talks about the investment of a company and Q. Tobin's Q. Is that, you seen that in your finance theory class somewhere? Okay, fantastic. So it's really related to this idea, right? Theoretically, we argue that investment decisions a company makes should respond to investment opportunities, how profitable it is in a company. So Q is meant to be a measure of marginal productivity of capital. Companies that have higher Q should have more investment. So what this paper found was that as a conglomerate, okay, their investment wasn't as sensitive to Q. But when you spin off into a new company, the investment decision of a spun off division is a lot more sensitive to Q of that division now. So that's an evidence of internal capital market where if you are a big company, a conglomerate with many divisions, the capital allocation decision within a big conglomerate may not be very efficient because you might not be able to redeploy your capital from the less profitable division to the more profitable division because of the issues we talked about in the Chestnut Food case. So this research found that once you split into different companies, then the investment decisions made by those divisions tend to be more responsive to the determinants of whether you should make that decision or not. And that's this paper over here. When you spin off the company, you can also say you allow management to keep the focus where it belongs. Right? You can have a management of a very big conglomerate, and they have to deal with many things. So when you spin it out to a new company, you can focus your efforts of management into what this company does best. So there's also evidence that when companies spin off, okay, their accounting-based profitability and also performance improve after the company's spin off. So that's also another idea you can do. You can guess, this guy, Kemano, is a guy who really is the expert in this area because most of the papers we talked about here have been by him. So all of this research actually linked to a broader research of should we be a conglomerate? Okay? Should we exist as separate small firms? Or shall we add our companies up into one big business group that does a lot of things? Like should SCG break up into SCG Chemical, SCG Paper, and so on, or should it exist as just SCG itself? So, okay, empirical evidence in the past, the consensus, in the field, I guess based on the first three papers, I guess, they said that if you're a conglomerate, chances are, as conglomerate, your management is less effective. So had you broken up your companies into different pieces, your valuation should have been more. Another name for that is the conglomerate discount. Okay, as a conglomerate, your valuation is at a discount relative to what you should have been. And that was general advice or general belief in the corporate finance field back in the 90s. And that led to a wave of what's called starbursting. Okay, you have a very big, good company, but they split off into smaller companies because of these findings that as a big conglomerate, you are actually a lot less efficient. So you should break up instead. So in the 1990s and 2000s and so on, early 2000s, we see a lot of companies splitting into smaller companies. Wave of starbursting. But more recently, not just more recently, there's also a strand of papers that still document more and more of this conglomerate diversification, both in terms of their value and also how people view firms. And the last one, I think, is another interesting take on conglomerates because they don't use the conglomerate value per se. It's more like an asset pricing paper that uses the fact that conglomerate firms are harder to value. They're more complex, so that when you look at something bad that happens to individual companies, the bad news that happens to individual companies get reflected in the price of conglomerates much later. So they said, if you see this predictability but delayed in terms of linkage, you can generate a profitable trading strategy where we look at individual small firm, pure play firms first, and see that if something good is going to happen to those individual firms, then something good is also going to happen to the conglomerate firm. So you can use that as a signal and then use that as a buy signal for conglomerate firm and so on. But it still points to the evidence that when you have conglomerates tend to be viewed as more complicated, therefore less valuable. Then more recently, there's a research that says, well, maybe conglomerates, the discount that you see, remember, conglomerate discount means you have a group of companies versus breaking up into smaller pieces. The sum of the part, they argue, the sum of the part is greater than what it is right now, so you should break them up. But a new strand of research says that when we look at the valuation of conglomerates, you have to separate some effects very clearly. Right? Number one, is it really about the effect on profitability of business, or is it more about the risk diversity in the business? Okay, so it's not very clear whether the discount that we see is because the risk channel, or is it because of cash flow channel, so we can't make a conclusion. More importantly, they said that if you match companies, conglomerates versus non-conglomerates, people who do M&A versus people who don't do M&A, then actually that's a well, that might be a different Sorry, I've been reading too many papers. I kind of forgot which paper says what. Okay, I think that this group of papers say when you look at companies, right? You have the conglomerate versus smaller businesses. The question is, when I add all this up, is it equal, or is it greater, or is it less than the sum of different parts? And they look at the valuation alone, right? The value, like market cap and so on, these enterprises. But if we separate out where we get these value from, it's free cash flow and WACC. And they want to say that, before we conclude that when you combine as conglomerate, is it creating value or destroying value? We should take a look at, is it happening through the cash flow effect or is it happening through the WACC effect? And this kind of research now focus the attention not on just the value, but also on the cost of capital of these companies. So that's the new addition of this kind of research to the literature on M&A. And then more recently, focusing on the risk aspect, that's actually a different finding that when you talk about conglomerate discount, you have to ask when are we measuring this? Because in good times, maybe, when you have conglomerates, it could be bad because you don't make decisions as well as you can in good times. But in bad times, on the other hand, if you weren't a conglomerate, then your access to capital market would have been restricted if you were individual small firms. If you're a large firm, so if you go to market as a large firm, so you can kind of cross-subsidize yourself in downturn. So being a conglomerate works if you're in a downturn. But if you're in the upturn though, the benefits may not be apparent. Okay. One of the things that I want to point out to you is that as a lot of research that we talk about, the origin of the research as theories tend to start off very simple, right? We tend to make a very general predictions about is this good or is this bad. But the more recent papers that people talk about now add more conditions. Is this good if? Is this good when? Okay, we try to understand more of the determinants as to why is this happening, and we allow the analysis to be more granular. And in terms of how you do your research, I think it's also a fruitful way, of looking at traditional research questions, the ones that people talk a lot about, and try to take a different look at it. Like if I cut my data a different way, if I look at some factors, may I look at some particular periods of time, do I see different results? And if I see different results, why is it I'm going to see different results? So here the argument was that in downtime, right, diversification, the theory goes like this, diversification, if we live in the MM world, diversification doesn't really matter because investors could actually diversify by themselves. I don't need you to be conglomerate because I can just buy a basket of companies and I can have a portfolio of conglomerates without relying on you diversifying. So the argument in the old day goes like this. But nowadays it's more like, well, if you are in a firm though, there are some other added benefits that, the idiosyncratic risks about the company may also be important. So, when we have external financing constraints like this, the MM theorems that we talked about don't really hold because a lot of the theorems that we talk about in the MM world tend to be very stringent. So, yeah, like, external financing constraints and so on. When we add all that to the theory, the prediction becomes a little different. So when you have external financing constraints, then the added benefit of being large, when you have internal capital market, you can transfer the success of one division to support the other division. Actually helps the company stay afloat more. Okay. So if you're interested in this topic, I suggest you read this one. I don't think you can access this directly from the access that we have. I have this paper, so I can send this to the line group. If you want to have a look at more of this topic about the conglomerates and the internal capital markets. Oh, by the way, internal capital markets simply means you have a group of companies like this. You have a headquarters up here. I need to allocate the capital that I have into different divisions, but when I go and raise capital, I raise capital as a big group conglomerate. So how do I allocate my capital to different business units inside my own division? And that used to be a very hot topic in the last 5 years, but now people are kind of gone on to other topics already by this point. Okay. So that's the IPO and spin-off and conglomerates issues if you are interested in doing research in this area. Before we take a break, I want to get started on the next issue that's related, right? If we have conglomerates, the question is how do we become conglomerates? Well, through mergers and acquisitions. You need to build more. Well, actually, one of the ways you can do it, you can do expansion yourself, but another way people become conglomerates is to acquire other people. So we're going to talk a little bit about this, the theories behind that. Your case next one is going to be about M&A. So I want you to at least have a picture about the important things about M&A first before you get to do that. All right, mergers, acquisitions, what do they mean? They really mean the same thing, but is it a forceful merger? Or is it a peaceful merger? Okay, if it's a forceful merger, I am acquiring you without your consent. But if I am acquiring you with your consent, we're merging. That's pretty much the separation between the two. So the words that words that are literally used sometimes is interchangeable between the two. Another way we refer to this is market for change and control, and then we refer to the buyer as the acquirer or the bidder, and then the seller as a target firm. Now, one of the simulations we're going to be doing in the last class is going to be an M&A case. Okay, so we're going to have, two parties. Okay? We're going to have two parties. One is going to be the company that's being acquired. The other one is company acquiring, and I'm going to match you up in two pairs. We have 6 groups, so we have 3 pairs. So you're going to be negotiating vis-a-vis each other about the possible outcomes that could happen based on this outcome. So we're going to be giving you some background over here. All right. When you buy a company, you can buy using cash, and when we say cash, we don't really care how we get the cash from, as long as you're paying cash to the target. You may use cash that you have already. You may issue shares yourself to get cash and pay, or you may borrow money to get cash and pay. From target perspective, they don't really care. As long as the target shareholders receive cash, that's fine. Another type of acquisition, I guess more like a merger, is to swap shares. So we combine the two entities instead. So the last one, okay, is more common for mergers than acquisition when you acquire using shares. Let me ask you, okay, if you're a target company, okay, would you be more happy with a cash acquisition or a stock acquisition? Let's think from the perspective of the acquirer. Okay, when will you pay cash and when will you pay stocks? If I am paying stock, what does that signal about me?
The synergy value is low. Synergy value is low.
Okay. Yes.
If I pay stock, that means actually the stock is going to value.
Quite likely, right? Because otherwise, why aren't you paying cash? If I'm paying one over the other, it either means I don't have any cash, not good, or I think my stock right now is overvalued, still not good for the target. So typically, okay, when you have M&As and then you acquire using stock, you tend to pay a little more. Okay, the target is going to want a little higher price for the acquisition compared to cash acquisition. So yeah, when you do a stock swap, okay, I don't think I have the calculation mechanics to show you here, but it basically just means sometimes we say, okay, you company A and company B, we're going to create a new share for, say, company C. And A is an exchange for C, and also B is an exchange for C. So we can see the exchange ratio of who exchange for what. You can also do a company A and company B, and company B is going to exchange their shares for shares in company A, the acquirer. That can also happen, okay, depending on, do I want to create a new entity, or do I want to just combine the two entities together? But no cash changes hand. So no cash changes hand. The confusing part is, when am I actually paying? Well, you are, because you're paying by giving up part of your company in exchange for ownership in the target company. So you're just not paying cash, but you're paying something equivalent to cash that can be assigned some value. And because of this, right, when you acquire using stocks, it tends to be valued less favorably than acquiring using cash. So that's another area of research that people talked about in the past is what are the determinants of cash acquisition versus stock acquisition? And when I do cash acquisition versus stock acquisition, which one is better? We can see in a moment it's actually very difficult to quantify whether an acquisition is good or bad. Right, M&A can happen in two directions mostly. Okay, either horizontal merger where you expand into the same business, but you just want to get larger. Or you can expand up and down your supply chain into something that is related, but either you buy your customers or your suppliers. That's a vertical merger. Or you can go into something completely unrelated. If I am an e-commerce company and now I want to own a sports franchise, like a football team, then there'll be a conglomerate merger in unrelated industries. Now, can you think of some reasons why people do horizontal merger? What would be example of horizontal merger?
Disney and Fox,
Disney and Fox, okay, because?
because they are in the same industry, media industry.
Right, if we believe that they are, say, content owners, then they just, and also content producers, then doing the same thing, then this would be a consolidation of their industry. So what would be the benefit of horizontal mergers? Why would one want to do it? Like a share, economies of scales, and maybe sometimes even bargaining power, right? If we are larger, then I have a greater share of the market as a buyer and also as a seller. So both monopolistic power and monopolistic power, we can do that. If you're larger, okay, are there any other benefits associated with being larger apart from economies of scales? If we were two companies, okay, so you have a larger presence, larger scale to enter new countries. Okay, so that's the benefit on the revenue side. Is there any benefit on the cost side to a horizontal merger?
Maybe a better access to the market.
Okay, so maybe your if by doing a merger your rating looks better and you have better access to capital market, or your scale is larger, so when you do an IPO or so, or SEO, anything with fixed underwriting costs is spread out over a larger size of issue. So that's another argument. Any other cost side? Yes, Ain?
Better resource allocation.
Okay, can you be more specific?
If both companies will bring their own resources, so and understanding and strength in terms of in terms of how to allocate all the resources they have.
Okay,
So that way, if they're better able to distribute it between the two companies, theoretically speaking, they should be able to maximize their resources available.
Okay.
That should lead to lower costs.
so let me add little details to your explanation to see whether we can take this further, right? Suppose I have two supermarkets. I am Tops right now, and I acquire maybe, what's a good example? There's no other supermarket, sorry? Gumeman, okay. Very unlikely, but suppose I do that. Actually, maybe an easy example. If I'm 7-Eleven and I buy Family Mart, what would be my first move when I buy Family Mart? Change Family Mart to 7-Eleven. Okay? Is there anything else I might do? I change the stores, but do I want to change all stores?
Trade off which one is cheaper.
Right, if you actually look at the overlap in our catchment area, if we see that, well, this area has 2 7-Eleven and 2 Family Marts, do I need 4 stores in this area? If I don't need 4 stores in this area, okay, maybe I can close down 2. And Family Mart is gone. People have to come to 7-Eleven. So they're all going to come to 7-Eleven anyway. I just need 2 branches in this area. Rationalization, right? I don't need to have as much fixed assets as before. We use, as 2 groups combined, we have a lot of fixed assets together as a 2 group. But we were competing. So we were expanding on these resources. But now that we're the same group, maybe we don't need duplicates. So anything that are duplicates, I can rationalize that. I can downsize that. I can right size that. Actually, downsizing, the people don't use that anymore. Okay, people use the word right sizing instead. It means the same thing, but when you say right sizing, it doesn't sound very negative. So any duplicates in terms of overhead, any duplicates in terms of fixed costs, we can eliminate. Right? So that comes to both the assets and people as well. Maybe I have 2 different accounting. Do I need 2 different accounting? Maybe I do. But if I don't, I can centralize accounting into one and then free up some of the headcount to other people instead. So that's the horizontal merger. What about vertical mergers? Why might you want to do a vertical merger? This is 7-Eleven making food themselves. Wait a minute, they do that already. But why might they want to do that? What's the benefit? Okay, reduce cost. One of the arguments is that if you recall your economics, right? If you have monopolistic power, you're charging price equals MC. That means you're charging a markup already. The price you charge with the markup as supplier becomes the input cost for the customer. And then the customer with monopolistic power charges a markup again. With double markup, you can actually theoretically show that when you do double markup like this, it is much better if you combine the 2 and then do a single markup and then redistribute the profit instead. The total amount of profit you can charge is actually much higher than doing a double markup along the line. So that's a theoretical argument behind why you might want to do a vertical merger, because you actually get a better allocation decision in terms of how many units you want to produce. When you have a double markup problem like this, you would end up under providing compared to what you could have done. But that's unavoidable because you're doing a monopoly decision twice. Any other reasons not related to maybe markups like this? Right, because sometimes they're my suppliers and I don't have full control over them. So they might not be up to my standards. So I might want to have the control of that myself so that I know exactly what I am providing. In operations management, there's a concept called the bullwhip effect. Okay, the bullwhip effect, it's like a whip. When you lash a whip, that's like a wave going up and down. The bullwhip effect says something happens somewhere along the supply chain, gets transmitted across the supply chain. So some problems with our supplier, very upstream, gets transmitted all the way across supply chain and gets amplified as we come down. When we lash a whip, the wave here is very small, but by the time it gets to the end, the wave becomes very big. So if you integrate your vertical supply chain, you can notice these problems before in advance, and then manage this before it gets out of hand. And there's also research on supply chain linkage, that when companies are identified as being suppliers and customers of each other, when a shock happens to one part of the upstream supply chain, the same shock gets transmitted to the downstream if you're a supplier customer. But if you are in the same group, okay, you can coordinate better to internalize this effect than if you were separate companies, because you share more information across the supply chain. So that's some of the theoretical reasons and also academic research that support this. So here's some legitimate reasons why you might want to do an M&A. So we talked about this already, economies of scale. You also have economies of scope. Right? Economies of scope would be something like, if I am a Thai Bev, what would be the benefit of me acquiring F&N, Fraser and Neat, who don't sell alcohol, but they have things like milk, things like fruit juice? So what would be my benefit of having F&N? Sorry?
Economy of
So yeah, can you explain a little more how do I implement that?
economy of scale is like you have many products which can use the same operation.
Right, so another name that you may hear is actually cross-selling. That's an example of economies of scope, right? If I'm selling Bia Chang to my customers already, I can tell them that if you still want my Bia Chang, you're gonna have to take my milk, you have to take my fruit juice too, otherwise I'm not gonna send you the beer. In fact, people use this before already, like, you wanna buy my beer, you have to buy my soda too. And you have to buy my brandy, you have to buy my beer. That's actually how Bia Chang got started in the beginning, right? They were actually not a beer producer, they were selling brandy. But the brandy is so successful that if you want it, you have to buy everything else Chang related as well. So that's, you can expand your portfolio using exactly the same selling channel and ask your customers to buy more, economies of scope. So why the things done using the same resources, economies of scope? Economies of scale, I'm just a bigger player so that my fixed cost is spread over more units, so the cost per unit I'm providing is lower, so I have cost advantage. Vertical integration we talked about. Okay? Sometimes you do an M&A for expertise. And what this means is, sometimes I want to hire you to work for me. Imagine I am a very big software company. I see a very promising company that I want to have you work for me. But you say, no, I'm not going to work for you. So what I can do is, okay, fine, you're not going to work for me, right? What about I acquire your company? And now I acquire your company and you as well. So you come and work for me now. If you watch a series by HBO, Silicon Valley, okay, you would see that the company has, the company in the series called Huli, but they really mean Google. Okay, Google has a lot of engineers working for them, not because they were originally Google employees, but they used to be owners of small startups that get bought. So they now become Google employees and work for Google instead. So that's acquiring expertise you didn't have before. That also works. Untapped resources. One of the reasons people talk about how the acquisition of CPO and Macro, right? Macro, the more like wholesale distributor of consumer goods, and CPO, 7-Eleven, why did they buy Macro? Well, they said they want to expand their distribution channel. That's one reason. But another reason, okay, an official reason was that Macro actually owns a lot of land in prime area. That when you look at the companies on balance sheet, they weren't being valued using market value. So if you revalue those plots of land that Macro holds, the value is actually a lot higher than the current market value in the market. But what that also means that, okay, you can buy on a sheet, but also if you believe Macro is underutilizing the plots of land, I can buy those land and then make better use of them. Another example of this is the acquisition of Amazon by Whole Foods, right? Amazon, the online retailer, Whole Foods, the grocery stores. And people are like, why the hell are you buying grocery stores? Well, now they're turning Whole Foods grocery stores into Amazon warehouse. Because Whole Foods supermarket they're located in prime locations around the country. They also have their own warehouses, which don't get used a lot, right? Because grocery gets delivered and then gets through the store and it gets empty. The storehouse gets empty very quickly. So there's a lot of waste resources. So what Amazon wanted to do was that, well, you have a lot of waste resources here. What about let me use it as storage too, and also as distribution center? So they now are better able to utilize the company, not just as a grocery store, but also as the headquarters for Amazon brick and mortar stores too. Industry consolidation. We used to have many ride-sharing companies, Uber and Grab. So what happens after Uber left Thailand? You guys using Grab? Have you noticed what the prices you're being charged? At least, right? I've heard some people told me that they stay late at night and at university here. Normal taxi would cost them about 80 baht to go home, but they went through Grab. It's nighttime surge pricing, so they had to pay like 240 baht to get home. So without competition, you can raise prices. So a way to do this is maybe just to acquire. Because remember, Uber didn't leave the country. Uber actually got acquired, okay, by Grab. So the two companies become one. It's not really leaving the country, it's just merging operations. So that's one way M&A sometimes helps. But as you can see here, right, if you're doing this and you're charging customers too much, then sometimes you get hit with the antitrust, okay, monopolistic behavior, and most countries have commissions that deal with this. So if you are spotted using your monopolistic power unfairly, they will bring charges against you. But they can do that in Thailand, because in Thailand, even though we have a commission, the commission is never appointed and never meet, so they don't really do anything in Thailand. It's the games we talked about. Okay. So let me talk about this and we can take a break. Okay. The other reasons that people talk about M&A, but they're not so legitimate. What are they? Okay. Now I have to talk about other stuff first. Okay, like overconfidence. Okay. If you're a CEO and you run a company versus CEO, you run a company and then you bought another company. When you go to a club where many other CEOs go, which one do you think is cooler? The one who runs the company or the one who acquires a company? Depends on your view, right? If you take the American alpha male view, then if you're able to acquire other people, you suddenly look a lot cooler in other people's eyes. So that's the overconfidence part. Right? I am confident, I'm successful, I want to look cool too. I am confident in my success track record at this company, so I'm going to acquire other company, I'm going to do well. There's research that says CEO overconfidence is negatively related to the returns to M&A. Empire building, okay? What do you think is cooler, managing a $500 million company versus a $1.5 billion company? Obviously, the latter one, right? The larger the company, the better. When you do an M&A, your company grows, that's for sure. But does your company create value for shareholders? That's a different question. You're a $500 million company, you acquire a $1 billion company, you become $1.5 billion company. But if you paid $1.1 billion for a $1 billion company, you're losing $100 million on that acquisition for shareholder. Still, your company value is still $1.5 billion. So if your goal is to increase size without respect to the value, then M&A always delivers an increase in size. M&A always delivers growth. M&A always delivers more profit. And if you do M&A without increasing your number of shares outstanding, you're increasing earnings per share. But are you increasing shareholder value or not? That's another issue altogether. Because sometimes companies do this. When you have a larger company, you get more perks as owners. You can get a private jet now. If you have a small company, maybe you can't make that argument. When my company is very big, I can start asking for more and more benefits. So the Jensen free cash flow argument actually, has some bite for the M&A activity too. Like sometimes managers just want to run a large company per se. Sometimes you hear arguments about surplus funds versus lower financial costs. I have a lot of money left, so I'm going to use that money to acquire companies. So that was the famous research looking at the oil companies in the past, where they had the windfall money from the quadrupling oil prices in the 70s. So they had lots of excess cash on hand. With that windfall cash flow, they went and buy a football team and baseball team, and then failed miserably. But they said, we have excess funds, so we have to deploy it. So not a good reason, typically. Lower financing costs. Sometimes people say, I'm a big company, so I can raise financing costs at very low. I can borrow at 3%. So I'm going to use this 3% borrowing to acquire a new company. Sounds like it makes sense, but remember, when you value a company, when you're buying, it's not about how much how the financing cost you can raise. It's about the expectation of what you're supposed to get from investing in that business. And that depends on the risk of the business. If you can raise financing at 3% and acquire a company that is very risky, the person who gave you financing maybe didn't know that you're going to use this financing to invest in that company. Had you had to raise the financing at that company itself, you might be charged a higher rate. Okay, so in fact, what you're doing is cross-subsidizing. You're subsidizing the value by using the success of your company to buy a really risky company. And that's a bad investment decision, because you're not using a risk-adjusted hurdle rate to evaluate the company you're acquiring. So this is going to be a central part, okay, when we look at how to value M&As. It is not going to be about the acquirer. When you value M&A, it is always going to be about the target. In fact, you can do a valuation without doing the valuation of the acquirer at all. All that you have to do is to look at the target, look at the target's value, and that's going to determine how much you should acquire the target for. So let's take a break and we'll come back and then do some